All right, hey everyone. It is Wednesday, about 3 o'clock. We are kind of just been crunching these numbers and reviewing them and trying to, understand what the USDA told us today and put it in context of price. So here's our spreadsheet, right? Here's where we were on the December report. Here's January. Here's the report they gave us today. And with corn, we increased the carryout just ever so slightly, and with beans, we increased it by 15 million bushels, which I think is maybe a little bit bearish compared to expectations, but we really didn't see big bearish movement, right? In fact, we'll look at the charts here in a little bit, and corn actually had a little bit of a bullish reaction relative to where it should have been, and I'm not really sure we understand that. So let's put this in context. So this report is really still talking about last year's crop, and when the marketing year gets all said and done, we're going to have that many bushels left over. That's 1,267,000,000 bushels. Now, in the coming months, and I can't remember, do you guys remember what month it is? Is it in April that they switch over?
Yeah.
I think it's in April when the USDA switches and we start looking at the new crop stuff, right? So after we plant a new crop in March and April and May and harvest it in October, November, December, and we go through that, then what's our carryout going to be? And soon that number, and this number here, goes to the beginning stocks number of that period. And so soon we're gonna shift our focus, and these acreage numbers are not relevant. So this is not looking forward. This report is looking backward, and all the USDA is trying to do is guesstimate demand. So if you hold demand the same, but plant 91 million acres of corn and you harvest 91% of that, and you yield trend line, which is about 180, then you end up with a carryout of 2.33 billion bushels. And this is what we've been talking about for a while. If you drop 3 million acres off of that, because, hey, maybe inputs are too high or whatever, and we get into a drought and we only yield 171.9, then our carryout is only a 1316. But that's in relationship to a 1267 today. So if we grow a normal crop and we look forward, our carryout grows. And I don't really see a whole lot of ways that it doesn't as we think through it. And this gives rise to our bearishness, right? This is why we think that we want to be hedged, because our primary job as an advisor to you, the producer, is to recognize when something significant might change that will cause and create downward pressure on prices, and this will do it. If our carryout, if our trade starts to believe that number, then down we go. And at some point, it will start doing this math. And I don't know other ways to look at it than this. Beans aren't any better. So if we plant 88 million acres of beans, and if we yield a 52, which would be a record, I think. I'm pretty sure our record is like 51 something. And our demand numbers stay the same. Our carryout goes from 225 to 450. So that's plenty of beans. We're not talking $15 beans or 13 in that instance. So the carryout swells radically, if just like corn does. And so I think you see a race to the bottom. And if you're watching the urea market at all, urea has just fallen out of bed, and it's in the relationship between urea and corn and wheat is at the lowest levels we've seen in several years, 5-6 years. So and historically, once the fertilizer market moves a quarter or two later, the grain markets tend to go the same direction. So I'm a little bit worried that fertilizer has already led the way lower here, and that grains are gonna follow suit. So I think even with today's reaction, it still makes sense that we not change anything about our perspective, even though technically, and I'll show you this here in just a second, even though technically we're starting to see a little bit more bullish setup. So we've got a complete contradiction between one way to look at the technicals and this balance sheet. So what do we do with that? Well, we've got to err on the side of caution and make sure that we are hedged, because one thing we know for certain is that eventually high prices will cure high prices. Okay, so let's look at the charts and show you exactly what it is I'm talking about. Come on, computer. There we go. All right, here are new crop soybeans. Zoom in on this just a little bit so you can see it. So new crop beans had an outside day, which means they traded outside the range of yesterday's high and low, and they ended up closing right near the open, which is right near unchanged. I don't think that means a whole lot, other than if it starts to work higher, then it could attract some buying interest. So we got to keep looking at the old crop beans to see what it is that they look like. So we keep seeing these long upper shadows and long lower shadows, which means that the market's undecided about what it wants to do as it balances the crop size in Brazil, the discounting the possibility of higher prices or higher carryouts here versus current tightness. And so, the report came out and we traded way off and to the low, and then we rebounded and closed right in here at this 15.19 level. That reversal could be bullish if this high gets taken out, and I don't want to take that off the table because of the way these things closed. So there is a possibility that this is going to catch fire and we're going to move into new highs. I don't see that that's going to happen, and you certainly can't really trade it until you start taking out highs, because you just got to assume that this is a lower high. We've had a series of lower lows, and that we're going to allow the sellers to overwhelm this market. But nevertheless, we did end about the same level as where the report came out, and which means that the market did not react bearishly to a higher carryout. So something could be going on here, and this could be a signal for that. Now, I don't want you to go get your bull hat on and say, "Hey, we're bullish. We're going up again." That's not what I'm saying at all. But I'm not gonna. We don't want to be naive and say, "Hey, we can't break out the top here short term." So we're gonna hold fast with below 1440, below 1450. We need to be short this market. 1540, 1550. Sorry about that. As long as we hold below those levels, we want to stay short, and we want to make the market take us out up above here, because if it does that and can muster that strength with the bearishness that we see, then something else might be going on that we need to talk about. But we don't know. And remember, philosophically, as technicians, we believe that price action is king, and we believe that all known information is reflected in current price. And yes, that means a big Brazilian crop, and yes, that means current balance sheet tightness. So in order to move it up or down, something has to give way. Either demand has to come in and exceed expectations, or demand has to fall short of expectations or fall off in order for prices to go down. And could that happen? Well, yeah, if soybeans start getting moved out of Brazil and China starts canceling and stops taking our soybeans, then this is going to drop like a rock. If the Brazilian harvest keeps getting delayed and they can't get in the field, and that puts more and more pressure on our front month in order to meet current demand, then yeah, we might have to go higher, because we are tight in the front months. So for now, we're going to hold where we are in March and not make any adjustments to positions. Okay, let's look at corn. Let me start with old crop, if I can find it. There we are. So corn has an outside day up today, has a full bullish engulfing candle, and it has a setup where its day is bigger than the prior day, and the prior day before that was bigger than that day too. So some technicians look at this as a buy signal, and it certainly could be, but we're going to hold fast and say, hey, not enough has changed from a balance sheet perspective, and in order for us to change that our view that 692 is the line in the sand. We want to hold short positions below that level, and we want to make sure that that we are protected against it. If we're able to trade up above it, then we'll revisit, and we may have to rethink it. But I don't see that for now. We need to see more price action that would change our mind. Let's just say and pretend that that is the case, and that we are going to go higher. Well, now before I do this, promise me you're not just going to ignore everything bearish that we say, because we like to be bullish too. But the reality is that if we do break this level, then 740 is our first target, and realistically, we're looking at a move to 760. And if things get exuberant, then we're looking at all-time highs in corn. I don't see how that is possible here, but my opinion doesn't count. So if we do break higher, then that's where we're going to be looking toward. But something has to materialize that's going to push it that way. What could that be? Well, it's not going to be more bushels in the U.S. The USDA has done the opposite. It took over 1 billion bushels out. It's not going to be new supply. Our harvest is done. We're not going to go find more of it. It's not going to be the fertilizer price is so sky high we can't afford to plant any acres, and so we're not going to grow a crop next year. That's not going to be the case. So it has to be drought or war or a shock demand, just as amount of demand coming from somewhere that's not currently buying from us, that would overwhelm the system and push us into higher prices and make us ration the front end. That's what has to be in order to do that, and I just don't see that in the cards yet. So hedged we should stay, and downward we should keep looking until evidence points us the opposite direction. And I'm sorry I did it again, but put wheat last. Again, that's just a habit. It's not because we care about wheat the least. It's just because that's how our screens are set up, is to go through corn and then beans and then wheat. All right, so wheat has an upward movement today. The USDA, and guys help me with this, they published the tightest balance sheet global supply since 2016. So the fewest wheat bushels on planet Earth since 2016 are there. So you're like, oh, well, hey, that's the tightest balance sheet. We got to go higher, right? Okay, well, let's look at that. Let's go to a monthly chart, and let's look at where wheat was back then. So the last time they printed a balance sheet that tight was back here in 16-17, when wheat was trading $4.50 to $5 a bushel. This is back in the days when you guys would have just loved anything above $5, and certainly if it had a 6 in front of it, whoever sold that for them was anointed. So we're $2 above that, guys. $3, sorry. We're $3 above the top end of that range, and the balance sheet's not that much tighter, right? It's not. Do we have numbers for that? Exactly what that is? We'll get it to you and put it in an email. But it's not that much tighter than it was back then, and we're $3 a bushel higher. So there is premium put in this market for war. There is premium put in this market for bad weather and drought, and like corn, the relationship between fertilizer prices and wheat is really attractive to buy fertilizer, sell wheat, because it's really wide. So we're not in the camp that anybody but wheat has to go back higher. Obviously, we would love for it to go back above 14 and go to all-time highs. I mean, that would be really, really fun to get long here and go. So let's talk strategy here for a minute about how we want to trade wheat. Well, here we are at $9. It's a historically elevated level. It's more elevated than it should be if supply and demand fundamentals are normal. And like corn, if we grow a big crop, there is a risk that global balance sheet starts to grow again. And let's be frank, if corn has a 3 billion bushel carryout, it is going to work itself lower. So how do you trade it? Well, hey, we have these magic lines. We have this cloud, and anything below that level, we want to be short. We also have this line, which is where this big move started, up at 945. Anything below that, we want to be short. Beyond that, looky here, you've got 1030. You've got lots of room to let this thing move and still stay short before it's really going to accelerate up. And let's face it, if you buy it at 10 and it goes to 15, that is a really great move. It doesn't matter that you didn't get it at 9. That's okay. What we want to do is not let it get above 950 before we take long positions to offset a short hedge or whatever. But anywhere below this, we want to stay sold. We want to collect time premium up in here, and we want to stay sold because we need some catalyst or some event that's going to push us higher. Now, what would that be if that's the case? If we break up higher here and we really do move, number one, what fundamentally could it be? Number two, what technically do we see that could cause that to be the case? Well, fundamentally, it can be war, right? It can be a restriction of bushels out of Russia. And I did read an article the other day that said that like 65% of the wheat in Russia is unavailable for export and is going to be wasted. And so maybe the numbers that Russia is giving us are suspect. I know we'd all be shocked if a sovereign nation lied about their numbers in order to make things better, but for themselves. But as we sit here today, that hasn't happened. We don't know that. All we know is that Russia is undercutting the world on price in order to move their bushels, and that's keeping a lid on it. What about the war and the trade corridor and ship safety? Yes, that could be bullish if those things materialized, but they haven't yet, and if they do, we'll move quickly. Now, technically, we do have a couple things here that are a little bit more bullish than bearish. The front edge of this cloud is ticking forward and getting ready to give us a bullish cross. We might break out of the top of this cloud, and we're trading above where we were 26 days ago, which is in and of itself bullish. So there are some cloud-based bullish systems here that are starting to manifest, and that could attract the interest of algorithms moving forward. So we're not quite as bearish technically as we have been, although we don't see the fundamentals to support a big move yet. But that's okay. If we get up above this line here, then we're going to go with it. Same with corn. It's the same basic line. Get above that, we're going to go with it and trust that the fundamentals will present themselves at some point. So for today, no changes, but we are. It is on our radar in order to move forward. So now a couple of housekeeping things. One, we're going to be out the next few days. We'll be back in the office on Tuesday. Phil will be here, and he'll be available, and he'll be watching the screens to take any action that you guys need done. If you have questions, email him, call him, whatever you need. You can email me or Jeff or Andrea, and we will get the message back to Phil, or we'll get to a spot where we can call you and visit with you. So don't hesitate to reach out. We will make sure that your needs get covered. Otherwise, I'm going to sign off for now, and we will talk to you guys next Tuesday. If something major happens, we will let you know and keep you all on top of it. Hope you guys have a great weekend. We'll talk to you soon. Bye-bye.